Think about the last time you received a paycheck, that moment when a number appears in your bank account, and for a brief second, you feel a sense of arrival, as if the work of the past 2 weeks has been captured and stored safely for future use. Now think about what happens next, not in the first few days after payday, but over the course of the following weeks as that number slowly shrinks, drained by rent, groceries, utilities, transportation, and the endless small transactions that make up a modern life. Most people interpret this pattern as the natural friction of existence, money coming in, money going out, with the hope that what remains at the end of the month is slightly more than what was there at the beginning. But buried inside this ordinary cycle is a number that almost no one tracks, a number that economists consider one of the most powerful forces in an economy, and a number that determines with mathematical precision the trajectory of your lifestyle over time. That number is the velocity of money, and while it is typically discussed at the national level, it operates just as ruthlessly at the individual level. The velocity of your personal money, meaning how quickly your income passes through your hands and into the hands of others, controls whether you feel constantly strained, comfortably stable, or genuinely able to build wealth. And the strange truth is that two people with identical incomes and identical savings rates can have radically different financial lives simply because their money moves at different speeds. Understanding this one number and learning how to slow it down may be the most overlooked lever in all of personal finance. The core concept of velocity comes from economics, where it is defined as the rate at which money changes hands in an economy, typically measured as the ratio of nominal GDP to the money supply. When velocity is high, money is moving quickly. People are spending and re-spending the same currency units, and economic activity feels vibrant. When velocity is low, money stagnates, transactions slow, and economies can fall into deflationary traps. But at the personal level, velocity works in a mirror image that is less intuitive. For an individual, high velocity means your money leaves you quickly, flowing out to landlords, grocery stores, utility companies, subscription services, and lenders. Low velocity means your money stays with you longer, circulating through assets you own, earning returns, or simply waiting to be deployed on your own terms rather than being pulled away by recurring obligations. The goal of financial health, therefore, is not simply to earn more or to save a fixed percentage, but to reduce the velocity of your own money, to make each dollar linger in your possession for as long as possible before it must depart. This sounds like common sense, but the structure of modern life is designed to increase velocity, to accelerate the movement of your money away from you and toward other parties who have built systems specifically to capture it on a recurring basis. Every subscription, every loan payment, every monthly bill is a velocity engine, pulling money out of your control at a predictable cadence. And because these outflows are automatic and regular, you stop noticing them, which means you stop noticing the speed at which your wealth is draining away. The psychological explanation for why velocity remains invisible to most people is rooted in how we process recurring versus one-time expenses. Behavioral economists have found that humans habituate to regular costs, a phenomenon sometimes called payment decoupling, where the pain of paying is reduced when the payment becomes routine and automated. When you sign up for a streaming service, the first monthly charge feels like a decision, but by the 12th month, you barely register it. This habituation is dangerous because it allows the velocity of your money to creep upward without any conscious choice. You are not deciding each month to spend that $15. You are simply failing to decide not to spend it. And the result is a steady, silent increase in the speed at which your income exits your life. The same logic applies to larger expenses like mortgage payments, car loans, and insurance premiums, which become so integrated into your baseline budget that you forget they are choices you made at some point in the past. The velocity of money is not just about how much you spend, but about how frequently you spend and how much of your income is committed to repeating cycles. A person who spends $2,000 on a single vacation once per year has a much lower velocity than a person who spends $170 per month on the same total amount, because the monthly spender has created a recurring rhythm that constantly pulls money out of their account, leaving less time for that money to be invested or to earn interest. The lump sum spender, by contrast, keeps their money for 11 months of the year, during which it can sit in an interest-bearing account or be deployed into short-term opportunities. The total spent is identical, but the velocity is dramatically different, and over a decade, that difference compounds. Let us bring the math into this discussion with a concrete comparison that illustrates how velocity, not just savings rate, determines outcomes. Consider two individuals, Alex and Jordan, each earning an after-tax income of $60,000 per year. Alex has structured their finances around low velocity, meaning they pay annually for insurance, property taxes, and subscriptions where possible. They own their car outright rather than leasing, and they have consolidated their recurring bills into as few monthly pulls as possible. Jordan has high velocity with monthly payments for everything: a car lease, a phone financed through the carrier, multiple streaming services, a gym membership they rarely use, and a credit card balance that requires minimum payments each month. Both save the same amount, $10,000 per year. But here is where the math diverges. Alex's $10,000 sits in a high-yield account for an average of 11 months before being deployed into a lump sum annual expense like property taxes or insurance, earning interest along the way. Jordan's $10,000 is effectively drained in small increments each month, never staying in their account long enough to accumulate meaningful interest. Over 10 years, assuming a conservative 3% annual yield on cash, Alex's strategy of holding money longer generates an additional $3,000 in interest, not life-changing, but meaningful. The real difference, however, appears when we consider the opportunity to invest. Because Alex's money is concentrated in fewer, larger lumps, they can more easily move a significant amount into an investment vehicle when an opportunity arises, buying a stock dip, funding a retirement account before the deadline, or making a down payment on an asset. Jordan's money is perpetually fragmented, trickling out in small streams, leaving them with only small, irregular surpluses that never accumulate enough to take advantage of anything. The velocity of money determines not only how much interest you earn, but also your ability to act on opportunities. And that ability is one of the strongest predictors of long-term wealth building. We need to zoom out now and look at the systemic mechanics that push most people toward high velocity whether they want it or not. The entire consumer economy is built on a subscription and recurring payment model because businesses have discovered that recurring revenue is far more valuable than one-time purchases. A company that sells a product for $100 once gets $100. A company that sells a subscription for $10 per month gets $120 per year, every year, with far lower marketing costs to acquire the next sale, because the customer has to actively cancel rather than actively buy. This asymmetry means that every business you interact with has a financial incentive to increase the velocity of your money, to convert you from a lump sum payer to a recurring payer, from an owner to a renter, from a buyer to a subscriber. The shift from owning software to subscribing to software, from owning music to streaming music, from owning movies to subscribing to streaming services, all of these are velocity increases disguised as convenience. The auto industry has moved aggressively toward leasing because a lease is a high-velocity product, pulling monthly payments out of your account rather than a single large payment every 5 to 7 years. Even groceries have been velocity optimized through loyalty cards and digital coupons that require weekly engagement, keeping you in the spending loop rather than allowing you to buy in bulk quarterly. The system is not conspiring against you in any malicious sense. It is simply optimizing for its own survival, and that optimization naturally pushes your personal velocity higher. To resist this drift requires intentional effort, because the default setting of the modern economy is high velocity, and low velocity is something you must actively construct. History offers clear parallels that help us understand why velocity matters so much and why previous generations had a different relationship with it. Before the widespread availability of consumer credit and automated payments, most people operated on a much lower velocity model. Workers were often paid weekly or even daily in cash, which meant money changed hands frequently, but also meant that every payment was a conscious event. Bills came as paper statements that required writing a physical check and mailing it, a process with enough friction that people tended to batch their payments, paying several bills at once rather than allowing automatic monthly pulls. More importantly, before the rise of subscription services, most goods were purchased outright. A pair of shoes lasted until it wore out. A tool was bought once. And entertainment meant a one-time ticket or a physical record that could be played hundreds of times without further payment. This lower velocity environment meant that a given income could support a higher quality of life simply because less money was leaking out in recurring dribbles. The same principle applies today, but the landscape has shifted so dramatically that most people under 30 have never experienced a world without monthly streaming fees, phone payment plans, and app subscriptions. What feels normal is actually an engineered high-velocity system. And what feels old-fashioned, batching purchases, paying annually, owning rather than renting, is actually a low-velocity strategy that frees up cash flow for investment and wealth building. Recognizing this historical shift is the first step toward reclaiming control over the speed of your own money. The identity shift required to reduce your personal velocity is not about becoming a miser or rejecting all modern conveniences. It is about moving from a passive recipient of recurring charges to an active designer of your cash flow architecture. The low-velocity identity asks, before every recurring payment, does this need to be monthly, or can it be annual, quarterly, or eliminated entirely? This shift in questioning changes the entire relationship with money. Instead of thinking about whether you can afford a $15 monthly subscription, you think about whether you would pay $180 up front for that same service, and that reframing immediately reveals which subscriptions are genuinely valuable and which are merely low-friction drains. The same logic applies to larger financial structures like housing, where a fixed-rate mortgage, despite being a monthly payment, actually reduces velocity compared to renting because a portion of each payment goes toward principal, which is effectively money you are paying to yourself, stored as home equity. Renting, by contrast, is pure velocity. Every dollar leaves and never returns. The identity shift is from consumer to cash flow architect, from someone who accepts the default velocity of their life to someone who deliberately engineers a slower, more intentional flow. This does not mean eliminating all recurring payments. Some are genuinely efficient and valuable, but it does mean auditing each one, questioning its frequency, and recognizing that every automatic monthly pull is a small hole in the hull of your wealth, and the more holes you have, the faster your ship sinks. Let us examine practical scenarios where velocity thinking produces better outcomes than traditional budgeting. Consider the decision of whether to pay for a year of car insurance up front or to spread it across monthly payments. The monthly option often carries a small fee or interest charge, but more importantly, it creates 12 separate transactions over the year, each one pulling money from your account and increasing your velocity. The upfront payment, Even if it requires saving for a few months, concentrates the outflow into a single event, leaving your money in your possession longer and often saving you the financing fee. The same principle applies to property taxes, professional association dues, software subscriptions, and even grocery shopping, where buying in bulk quarterly rather than weekly reduces the number of transactions and keeps more money in your account for more of the year. Another powerful velocity reduction strategy is to consolidate due dates, contacting service providers to align all your major bills to the same day of the month. This does not change the total amount spent, but it changes the pattern, leaving larger blocks of time between outflows during which your money can sit in an interest-bearing account or be available for unexpected opportunities. The extreme version of this is to pay as many bills as possible with a single credit card that offers a grace period, then pay that card in full once per month, effectively turning dozens of small outflows into one large outflow, drastically reducing velocity while also earning rewards or cash back. None of these moves require earning more money or cutting total spending. They simply rearrange the timing of outflows, and that rearrangement alone can add hundreds or even thousands of dollars to your net worth over time through preserved interest and reduced friction. The calm closing to this exploration is an invitation to see your cash flow not as a simple in and out equation, but as a dynamic system where timing and frequency matter as much as amounts. The velocity of your money is not taught in schools, not tracked by budgeting apps by default, and not discussed in most personal finance advice, but it is one of the most powerful levers you have. You can increase your income and still feel strained if your velocity is too high, and you can live comfortably on a modest income if your velocity is low. The goal is not to stop spending, but to slow the spending, to extend the time between when money enters your life and when it leaves, and to use that time to let your money work for you rather than for everyone else. Start by looking at your bank statement and counting the number of automatic recurring transactions in a typical month. Each one is a point of velocity, and each one is an opportunity to ask whether it can be reduced, batched, or eliminated. This is not about deprivation. It is about design, about recognizing that the default speed of modern financial life is faster than it needs to be, and that you have the power to slow it down. The one number that controls your lifestyle is not your salary, not your savings rate, and not your investment returns. It is the velocity of your money, and once you learn to measure it, you can learn to master it.